Most people think you need $1 million to retire and earn $5,000 a month. But what if I told you, you could start with just $1,000? That's less than your last vacation, and without ever selling a single stock, you could build a portfolio that pays you a reliable, growing income for life. Today, I'm going to show you step by step how to use Fidelity Index Funds to create an income engine that could one day replace your salary. We're going to break down the biggest mistakes people make, the exact funds I picked, and even how you can reach your income goals 10 years faster than most people think possible. Hey everyone, today, I want to talk about something that might completely change how you think about investing and building income. The median American income is about $5,000 a month, and when most people hear that, they think, I need $1 million to make that in retirement. But here's the thing, that's just not true. In fact, you don't need millions, and you don't need complicated strategies like day trading, crypto speculation, or buying multiple properties. You can start small, as little as $1,000, and start building a reliable income that grows over time, using one of the simplest, most effective investment tools, Fidelity Index Funds. In this video, I'm going to take you through the full process of building a dividend-paying Fidelity Index Fund portfolio that can eventually cover your living expenses. I'll show you exactly what I did, why it works, and how to avoid the mistakes most people make when chasing dividend income. Let's start by talking about index funds. When most people think about getting rich or generating income, their minds immediately jump to risky strategies. Buying rental properties, picking the hot stock of the month, maybe throwing money into crypto, and yes, all of those things can work. But they usually come with high risk, massive stress, and far more effort than people anticipate. Take real estate for example. Owning property sounds stable, right? But unless you have a huge down payment, you're stretching yourself financially. Then there's the ongoing stress, dealing with tenants, repairs, late-night emergencies, and all of that can eat into your profits. Especially if you hire a manager. Stocks can be fun at first, but a single earnings report or a market downturn can tank your investments overnight. And crypto? Don't even get me started. That's basically a roller coaster without a seatbelt. One tweet, one regulation, or one unexpected event can erase months of gains in seconds. Now, let's compare that to index funds. Index funds are low-cost, diversified, and incredibly simple. Instead of putting all your money into one company and hoping it succeeds, you're investing in hundreds, sometimes thousands, of companies. This diversification spreads out your risk and smooths out the volatility. You don't need to constantly check the news or panic during market swings. You buy, hold, and let time do the heavy lifting. Over the long term, this is one of the few strategies that reliably builds wealth, even while you sleep. For what we're doing in this video, creating a steady growing income, index funds are perfect. They combine simplicity with compounding power. Before we get into the funds I picked, we need to clear up a huge misconception about dividend investing. Most people hear dividend and think, I need the highest yield possible. They're hunting for funds that pay 7%, 8%, or even 10%. That sounds amazing, right? But here's the truth. High yields are usually a warning sign. A high dividend yield often comes with higher risk. If a company or fund is offering unusually large payouts, it's usually because the market doesn't trust it to grow. That dividend might not be sustainable. The share price could be stagnating or falling, and investors are being compensated today with a big payout for the risk they're taking. If that dividend gets cut or the underlying investment crashes, that so-called safe income you were counting on just disappears. Suddenly, your plan for retirement or passive income, well, it falls apart. So, what's the alternative? Focus on total return, and that's really a combination of three things. First, dividend yield, which is the income you get right now. Second, dividend growth, meaning how much that income increases over time. And third, share price appreciation, which is the long-term increase in the value of your investment. It's honestly not about how much you earn today. It's about how much that income grows and how your portfolio compounds over the years. For example, a fund with a modest 2.5% yield, but strong 15% annual dividend growth and steady share price appreciation will, outperform a 7% yield fund that doesn't grow. This is the secret to building a dividend engine that really scales with you over time. So, how do you actually choose the right index funds? First, you need to ignore the hype. Forget about chasing the latest trend or reacting to headlines. Your portfolio should be built on solid principles designed to maximize total return and sustainable income. Okay, so here's how I approach it. First, I look for a reliable dividend yield. I always start with funds that pay a steady, healthy dividend, not too low but not suspiciously high either. This provides a foundation, a starting point for income that's consistent and predictable. The money you earn just for holding these funds becomes the base of your dividend engine. Next, I focus on strong dividend growth. Honestly, this is where most people fail. You can't just look at what a fund pays today, you have to check out its track record. I prioritize funds with a strong 10-year KAGR and dividend increases. Why? Because dividend growth compounds. A 15% annual growth rate doubles your payouts in about 5 years. Over time, this creates a serious income stream. Third, I consider share price appreciation. I'm not just chasing dividends here. The portfolio also needs to grow in value. Price appreciation increases your wealth, protects against inflation, and boosts your long-term returns even if you never sell. So, I select funds with strong historical growth across different market conditions to ensure stability and upside potential. And finally, diversification is crucial. I choose funds that give exposure across different sectors and regions: U.S. mid-cap stocks, large-cap U.S. companies, international exposure, and even ESG-focused funds. This spreads the risk and captures growth from multiple angles, not just one segment of the market. A lot of people ask, why not just invest in the S&P 500? And yeah, it's a solid long-term growth strategy, but if your goal is to live off dividends, the S&P 500 alone just won't cut it. So, let's break down the numbers. S&P 500 ETFs like SPY, VO, or IV yield around 1.27%, with about 6.36% dividend growth and 10.85% annual price appreciation. If you want $60,000 a year in income, that's about $5,000 per month. You'd need nearly $4.72 million invested. Even if you stretch your timeline out to 30 years, you'd still need about $750,000 just to earn $60,000 a year from dividends alone. Why so high? These ETFs are growth-focused. Most of the returns come from price appreciation, not cash payouts. To live off them, you'd have to sell shares, which isn't sustainable. Here's how my portfolio is different. It's designed to provide steady, growing income without touching the principal. We focus on moderate yields, strong dividend growth, and share price appreciation. The 5 Fidelity Index funds I picked are, first, Fidelity Mid-Cap Index Fund, or FSMDX. This is the income grower, with a dividend of 2.27%, dividend growth at 23.67%, and price growth of 6.53%. Second, Fidelity Zero Extended Market Index Fund, or FZIPX. It has a modest yield of 1.19%, dividend growth at 19%, price growth at 5.08%, and, some international exposure. Third is Fidelity Zero Large Cap Index Fund, or FNILX. This one's reliable, with a 1.02% yield, 17.21% growth, and 12.09% price appreciation. Fourth, Fidelity Zero Total Market Index Fund, or FZROX. The yield here is 1.09%, dividend growth at 19.21%, and price appreciation at 11.6%. And finally, Fidelity U.S. Sustainability Index Fund, or FITLX. This one's got a yield of 1.22%, dividend growth at 18.07%, and price appreciation at 10.68%, plus it's ESG focused. So, when you put it all together, This portfolio delivers a 1.36% yield, a 19.62% dividend growth, and 9.22% price appreciation. It really creates a reliable, diversified income engine. You don't need a huge lump sum to begin. Just start with $1,000, then contribute $1 a day or $30 a month. After year 1, you'd have about $1,466. By year 10, that's $9,183. After 20 years, it grows to $45,287. And by year 30, you could have $441,188, with $6,644 a month in dividends. Want to accelerate? Start with $20,000 and contribute $20 a day. By year 10, you could already be generating $5,725 a month in dividends, and you'd be approaching nearly $1 million in portfolio value. Now, let's break down why even small investments grow into a meaningful income engine over time. Compounding is the key. Compounding happens when the dividends you earn are reinvested to purchase more shares. Those new shares, in turn, earn more dividends, which get reinvested again. Over time, this creates a snowball effect that accelerates your income growth. For example, if you start with $1,000 in a fund yielding 2% and reinvest every dividend, after 10 years, you aren't just earning 2% on your initial $1,000, you're earning 2% on a growing base that now includes reinvested dividends and any price appreciation. By year 30, the majority of your income may come from reinvested dividends rather than your initial contributions. This is the power of long-term investing. Small, consistent contributions plus reinvested dividends compound exponentially. It's why even $1 a day can eventually produce thousands of dollars a month in income decades later. Most people have been told their entire lives that the only way to retire comfortably is to become a millionaire. They believe you need a massive 7-figure portfolio just to earn something like $5,000 a month, enough to live on, travel a little, and not worry about unexpected bills. But what if I told you that's simply not true? What if I told you that you could begin building a real growing income stream for the rest of your life starting with as little as $1,000? Yes, less than the cost of your last vacation, the last phone you bought, or even what some people spend in a month eating out. And what if you could do it without ever selling a single stock, without timing the market, and without gambling on risky strategies? Today, I'm going to show you step by step how to use simple Fidelity Index Funds to build what I call an income engine. A machine that quietly grows in the background until one day it becomes powerful enough to replace your salary. In this breakdown, I'm going to walk you through everything, the biggest mistakes people make when trying to build passive income, the exact funds I selected, and why I chose each one, and the strategy that could help you reach your long-term income goals years, even a full decade, faster than most people realize. Hey everyone, today, we're diving into a topic that has the potential to completely change the way you think about investing, wealth, and long-term financial freedom. Most people hear that the median American earns about $5,000 a month, which is roughly what many people hope to bring in during retirement, and they immediately jump to the assumption that they'll need about $1 million in the bank to make that happen. It sounds logical at first. After all, if you want $60,000 a year, and the safe withdrawal rate is supposedly around 4%, then the math seems to say you'll need $1.5 million to even be comfortable. But here's the truth, nobody tells you. You don't need millions, you don't need complicated strategies, you don't need to gamble, and you definitely don't need to start big. You can start tiny, with just $1,000, and still create an income that consistently grows over time. All you need are the right tools, and a strategy based on real, proven long-term principles. And the tool that makes this possible for everyday investors is something incredibly simple, accessible, and low-cost: Fidelity Index Funds. Today I'm going to walk you through exactly how I built a long-term dividend-focused Fidelity Index Fund portfolio designed to eventually cover monthly living expenses. I'm going to show you exactly what I did, how it works, and the biggest traps and misconceptions to avoid when building income from dividends.